Welcome to this explainer. Okay, today we're taking something that usually just sits gathering dust on a corporate shelf. Standard operating procedures. And we're going to see how they actually form a fascinating playbook for building a literal bulletproof corporate fortress. I know, it sounds like dry paperwork, but it's actually the secret architecture of business survival.
So how does an enterprise protect itself from fraud, theft, and just total operational chaos? It's a crucial question because, a business isn't just a great idea or a charismatic founder. It's a massive, complex machine that's constantly under threat from both internal mistakes and external risks. We're going to look at the exact mechanisms that keep that machine from just flying apart. Here's our roadmap. We're looking at 5 key areas: managing the cash flow, fueling and growing capital, building and tracking assets, people and technology operations, and finally, the ultimate financial scorecard. But before we build our fortress, we really need to understand our primary building block, the SOP. Think of a standard operating procedure as having 2 distinct identities. On one hand, it's the engine that makes the business run efficiently, the workflow. But on the other hand, it's the reinforced shield that protects it, the internal control. You literally cannot have one without the other. All right, let's start with section 1. Managing the cash flow. This is absolutely the lifeblood of any organization. It's kind of fascinating how we can compress the entire highly complex sales cycle into 5 clear, manageable steps. We're tracking the whole journey from that initial non-binding MOU right through the delivery of goods all the way to accounts receivable finally clearing the invoice. It's just a beautiful, logical flow of revenue. But an engine needs a shield, right? Here's where the risk and control matrix comes in. Look at how we defend against stolen funds. We use something called segregation of duties. That basically means the person physically handling the cash can never ever be the same person updating the digital accounting ledgers. And my personal favorite, stopping warehouse errors using blind counts. Instead of giving warehouse staff a checklist that says, hey, expect 50 boxes, which they might just lazily check off, you give them a blank sheet. They actually have to physically count the boxes to receive the goods. It's incredibly simple, but flawlessly effective. Now, consider the very real danger of procurement kickbacks, where someone inside secretly colludes with an outside supplier. We neutralize this vulnerability by forcing all purchases through an audited, approved vendor list. For anything over a certain dollar amount, the system physically locks until 3 independent quotes are uploaded. The vulnerability is entirely neutralized by the process. Moving beyond just the daily cash flow of buying and selling, we have to ask a much bigger question. How does an enterprise protect its major financial moves when the stakes get, exponentially higher? And that brings us to section 2, fueling and growing capital. This covers the massive financing and investment cycles that really dictate a company's long-term future. The financing engine follows a very distinct high-stakes workflow. It starts with forecasting long-term cash deficits, which then triggers some pretty aggressive negotiations with banks or equity investors. Once you secure those mandatory board and regulatory approvals, the funds are carefully mapped upon receipt. But it doesn't end there. Strict monthly tracking kicks in to service the debt and maintain financial covenants, like your debt-to-equity ratio, just so the bank doesn't instantly recall your loan. To prevent catastrophic, literally company-ending losses during these high-stakes moves, the defense matrix has to be absolutely ironclad. You aren't just trusting one executive here. The control requires a dual signatory framework. That means you need dual board sign-offs before a single wire transfer is executed for capital deployment. Plus, before loan notes are even signed, the legal department must do a strict statutory verification to make sure the company isn't accidentally breaching its own legal borrowing limits. Now, capital doesn't just stay as numbers on a screen forever. It eventually turns into tangible things: factories, servers, heavy machinery. And the exact moment money becomes physical, well, it introduces a whole new set of vulnerabilities. Let's jump to section 3, building and tracking assets. We'll see how we defend our physical infrastructure and these massive capital construction projects. Imagine a brand new server arriving. The second it hits the loading dock, it gets tagged with a unique barcode and entered into the master data setup, which is known as the fixed asset register. From there, the system just automatically ticks down its depreciation every single month. The asset gets physically counted every year, right up until its final formal disposal and write-off. The absolutely crucial point here is combating what accountants call ghost assets. These are things that look totally fine on your digital balance sheet, but in reality, they were stolen, broken, or scrapped months ago.
The control for this is brilliant in its sheer brute force, the annual wall-to-wall inventory. You force the virtual ledger to face reality through an independent physical audit. Basically, if the barcode isn't actually in the room, it comes right off the books.
But, a fortress, no matter how thick its walls are or how strict its inventory checks might be, is really only as secure as the guards walking the walls and the communication networks they rely on every single day.
Which brings us to Section 4, People and Technology Operations. Here we're looking closely at the HR and IT cycles.
There is such a fascinating metric hidden in here. In payroll, a variance of greater than 2% compared to the prior month acts as an automatic system-level tripwire. If the payroll jumps by more than 2%, the system instantly demands individual line item validation. This is exactly how you catch someone slipping in fake overtime or maybe an unauthorized salary bump, way before the money ever leaves the bank.
And the security matrix here is just wild because of how automated it is. In HR, the biggest fraud risk is the ghost employee. Basically a fake identity created by a rogue manager to funnel paychecks directly to themselves. The control? The HR system automatically locks new IDs from the payroll run until an independent third-party background check completely clears. Meanwhile, over in IT, the absolute nightmare scenario is ransomware. The ultimate shield against this is write once, write many, or worm technology. These are immutable off-site backups. So even if a hacker breaches your network, they physically cannot overwrite or encrypt those worm backups. Your data survives.
So how do we prove to the outside world that all these operational shields are actually working? Everything we've built so far, the sales workflows, those blind inventory counts, the worm backups, the payroll tripwires, it all culminates in one final test of truth. How do you actually prove your fortress is secure to investors, regulators, and the market?
Welcome to Section 5, the ultimate financial scorecard. This is all about the financial reporting cycle.
This is the vital workflow where literally thousands of raw daily actions become a single, coherent scorecard. Standard journal entries are prepared, and sub-ledgers are pushed all the way up to the master general ledger. After rigorous bank and intercompany reconciliations are done and trial balances are run, the actual income statement and balance sheet are finally drafted. To guarantee the integrity of this final scorecard, the controls have to be absolute. Strict system segregation ensures that the person creating a journal entry can never, ever be the one to approve it. That stops someone from quietly hiding a massive loss. And right before the world sees the numbers, the chief financial officer must manually sign off on a rigorous financial disclosure checklist, making sure everything fully complies with global accounting standards.
When you look at it this way, understanding these systems transforms standard operating procedures from a dry, bureaucratic chore into your absolute ultimate survivance strategy. It really is the blueprint of your corporate fortress, and it leaves every leader having to ask themselves one incredibly provocative question. If someone tested your business engines today from within, would your operational shields hold, or would the fortress crumble? Thanks so much for joining me on this explainer. Keep learning, and I'll see you next time.